Hey everyone, welcome in to another daily editorial here on the KE Report. I'm happy to introduce a new guest to the show, Jim Tassoni. He was introduced to me from our good friend Joel Elconin over at the Benzinga Pre-Market Prep Show. Jim is the CEO of Armor Wealth Strategies. He's an active trader slash investor. I'm going to be talking with Jim about his views on the markets, and especially now with this change in central bank policy where it's the Fed and other central banks starting to cut rates. Jim, thank you first and foremost for joining us on this show. You and I have been chatting off mic for a little while here. I'm excited to bring on you with your thoughts on these markets and some of the opportunities you are seeing. Let's start off with what seems to be a bit of an inflection point for markets, where the Fed just reduced rates earlier this week by 50 basis points. Other central banks have been reducing rates over the last few months. What's important here for investors, Jim, to understand this different environment that we are moving into?
Yeah, absolutely. And first of all, thanks, Corey, for having me on. And I appreciate the opportunity. And it's always fun to chat about markets, and definitely appreciate Joel making the introduction. But as you said, we are in this inflection point now in the markets. We just saw the Fed cut by 50 basis points. I went back and looked at the last 50 years of data, and really the only other corollary I could find to when the Fed cut 50 basis points with markets close to or at all-time highs were, eerily enough, September 18th, 2007. It's only happened one time before. And we actually, the day of the rate cuts at that time, had a huge rally in the markets as well, a near 5% rally. Unfortunately, the subsequent 3, 6, and 12 months didn't fare as well. We were down about 4.5%, 3 months out, about 12%, 6 months out, and about 7%, 12 months out, taking us to September of 08. And we all know what happened from there. Now, I'm in by no way, shape, or means calling for that type of a crash. I think that there's some things that are different, but there's also some similarities. And so I think you need to trade the market in front of you, but I think it's also very important to pay attention to history and what might be potentially occurring as we move through it.
So, Jim, what's different this time about this point in the economy, in the markets, when the Fed is cutting? Because you're right, we do hear a lot of historical references that when rate cuts come, markets roll over. But these rate cuts, especially this one, has been forecasted for 2 years now, and it's not as if the U.S. economy is completely imploding in on itself.
And I think that's a very important point, Corey. I think one of the things that's very different, first of all, is our economy is markedly different 17 years later than it was in 2007. We have different types of companies leading the way, a different type of overall industry here in the United States, and an overall global economy that looks very different than it did 17 years ago. With that being said, I think we also have to pay attention to the fact that the markets continue to already have discounted a lot of this pricing in. And like you said, this isn't something that's catching anyone by surprise. So the fact that we already knew all this was coming, and yet the markets are still holding up, still staying above key levels, I think that's the bullish argument for this market. And that's why I said trade the market in front of you, not the market that maybe history is telling you that should be coming, because that's a path to a lot of pain.
Now, what I find so interesting about this market is that it was a lot last year, maybe even further than just last year, where everyone was saying these markets, they're being carried by the Magnificent Seven. That's not a healthy market. And recently, well, we've seen a broadening out. We have the equal weight S&P now back to all-time highs, with the normal S&P also right around all-time highs. We've seen a big fade in the tech stocks, but we also have people saying, this might be late cycle action for markets. Where do you stand?
Yeah, so from that front, I 100% agree. The broadening is great to see. The equal weighted S&P, we had that day, reversal day a few weeks ago. I think it may have been last week where the market was down on its lows. And then we saw tech, the semiconductors, they bounced. I think the semiconductor index from 10:30 in the morning to 4:30 in the afternoon was up about 6%. And the S&P 500 outperformed the equal weight by over 1% that day. So very narrow participation. That had me concerned. But the great thing is since that happened, we've seen a huge broadening. We've seen the catch-up trade from the equal weight. We've seen small caps start to perform. That's another area that I really like here. I think if we get interest rates coming down, I think small caps are set up really well. Now, I am not a fan of just going out and broadly buying the IWM because if you look at that index, about 60% of those companies are unprofitable. And I don't know about you, Corey, but I'm not a fan of buying unprofitable companies. So I prefer a more active approach in the small cap area. But I think that's a space that investors could look for if we continue to see a broadening and or a rotation in this market.
So is it very much a catch-up trade? There's a number of sectors that have lagged, not just the small caps. Are those broadly the areas that you're looking at? Those ones that are maybe off their highs still?
Yeah, I do like some of those areas. I still though am a fan of having some exposure to the tech sector. I think there are still companies, whether it be a Meta, a Google, maybe some of these companies that haven't quite had the run-ups of some of their Mag 7 partners. We've seen Meta start to break out this week. We've owned that stock for a while. Google's one that's kind of been hovering around. We like that. But yes, there are other areas. I mean, you have to look no further than gold miners. That's another area that we're very bullish on right now. And I think part of that reason is you look at the overall commodity, whether you look at the GLD or gold futures, and what a year that commodities had, up close to 30% on the year, outperforming pretty much every other market out there. But if you look at the overall constituents of the GDX, the actual gold miners, they've been languishing. And I think that there's room for a catch up there. I think there's a lot of factors that lead me to be bullish on gold, even at these levels. I think it's going to continue to move higher. And I think being in the miners could be a great catch up trade with the overall commodity.
Let's dive more into that because we do talk a lot of metals and precious metals on the show. And look, it's been no secret that the gold miners have drastically lagged the underlying gold price, which gold price continues to hit all-time highs. Something like the GDX still trying to get above its 2020 high and a ways off from its highs of over a decade ago. What's the potential for something like GDX then?
Yeah, I think, like you said, I think that there's a huge upside potential here. We actually got long GDX at this 39.67, what we consider to be a breakout level here. We're now trading about 40.30 as of the recording that we're at here. And we see significant upside from here. Now, I'm not going to put a specific number on that, but I would say that as long as we continue to trade above this 37 area, I think you want to stay long GDX. I think that's an area that you can hold a position against. If we close below 37, I would probably say, at least from a short-term standpoint, you might want to step aside. But I think that's a great level to trade against from here. I think you can be long. If you want to look for a more attractive entry point, you can see if we get a pullback to that 39.65, 39.70 area. But I really like GDX. It looks like it's starting to break out to me, holding above that 39.70 area, and I see a lot more upside ahead.
So is this a momentum trade now? Could GDX possibly have switched to where some other investors might come in because of the upward momentum we've seen that really started in March?
Yep. I think you're spot on, Corey. I think not only is there some momentum starting to get behind this trade, but you also have the tailwinds of the catch-up trade. I think some of that pricing in the commodity itself, like you said, the futures or GLD, is starting to be passed through now to these miners, and people are starting to wake up to the fact that profits are going to increase in these companies. They're becoming more efficient. Their pricing that they're getting for their commodity is significantly higher. And so you've got fundamentals working in your favor. You're now starting to get momentum working in your favor. And in addition, you've got that catch up versus the underlying commodity.
So where do you see gold going to in this rally too? Is gold seems to be a momentum trade, has been for a little while now, but that's breaking out to all-time highs. So how much more could gold run to support this GDX trade?
Yeah, and gold is, I still like gold. I've been fortunate enough to be long gold for a few years now, and it's been a great trade. I still favor GDX over the underlying commodity here just because I think there's more oomph to the upside, and there's all of those catch up underlying fundamentals that I talked about. But I don't fight the tape. I don't fight the market. And we've talked about that throughout our segment. Trade the market that's in front of you. From an underlying price standpoint, I think right now we had another breakout here above 26.17. That was our level to look for another leg higher. We're getting significantly above that again. That would be the level that I would look maybe to add or get long if we came back and held that 26.17 area. But as long as we're, in my analysis, as long as we're above about 25.40 here on the short term, if any close below that, I might move to the sidelines, but I still would be very careful shorting here. We're a little bit overbought by some of my signals, but it's a really strong momentum tape to fight and try to be cute and pick a short here.
Okay. Hey, Jim, thank you very much for your time. We'll wrap it up here, but I'm going to bring you back on the show and we'll dive into some other markets, some other opportunities that you are seeing within the markets. And I like that whole strategy. Trade what the market is giving you. We hear all the time people trying to fight the markets and sometimes just flat out complain that the market's not doing what they thought when sometimes play those trends, right? And when there is a trend, just embrace it. Jim Tassoni, CEO of Armor Wealth Strategies. Jim, it's great chatting with you. Thank you very much for joining us on the KE Report.
Thanks, Corey. Have a great one.